Is a crash on the horizon? Or is this your golden opportunity to turn chaos into crypto riches? Welcome back to the channel. Today we're diving deep into the question everyone's asking: crash coming? How to survive September and position yourself to get rich from altcoins. With Bitcoin's recent dips, seasonal patterns, and macroeconomic shifts, September could be a make or break month for traders and investors alike. But don't worry, whether we face a correction or a rally, I've got the insights, strategies, and tips to help you stay ahead of the game. So, if you're ready to understand what's really happening in the crypto world and learn how to position yourself for maximum gains, come let's dive into the video and get started. The market backdrop. Bitcoin experienced a notable decline recently, driven by low liquidity conditions typical of late summer. However, this dip coincides with a crucial shift in Federal Reserve policy. Jerome Powell's announcement at Jackson Hole that the Fed is moving away from its traditional 2% inflation target. This signals greater flexibility in monetary policy, opening the floodgates for more liquidity and risk appetite. Many believe that this change could ignite a new wave of asset inflows into riskier investments like cryptocurrencies. Adding fuel to the fire, Ethereum, ETH, is gaining increasing attention on Wall Street. Tom Lee, a prominent analyst, is now suggesting that ETH could even flip Bitcoin in network value, an extraordinary claim that underscores Ethereum's rising institutional appeal. Lee draws a compelling analogy to 1971, when the dollar left the gold standard, sparking a transformation in financial markets. Today, he argues, Ethereum and blockchain technology are catalyzing a similar revolution, making markets faster, more efficient, and more interconnected. The significance of September. One of the most intriguing aspects of market speculation is the seasonal pattern associated with September. Over the past decade, September has often been a tumultuous month for cryptocurrencies, characterized by sharp sell-offs that, paradoxically, have often been followed by significant rallies. Historical patterns of September dips. 2017. September saw a massive decline, with Bitcoin dropping roughly 40% from its highs. Despite this, the market soon recovered, eventually rallying into the year-end and setting the stage for the historic bull run of 2017 to 2018. 2021. Once again, September experienced a notable correction, but it was part of a broader pattern of volatility that culminated in Bitcoin reaching new all-time highs later in the year. Why does September often signal a turnaround? Many traders believe that September's volatility is due to a combination of institutional portfolio rebalancing, tax loss harvesting, and the end-of-summer trading lull. Institutions and traders tend to reposition their holdings ahead of Q4, which historically has been the most profitable quarter for crypto assets. Furthermore, September sell-offs often shake out weaker hands, leaving behind more committed investors who then capitalize on the subsequent rebound. This pattern has been reinforced over multiple cycles, making it a potential indicator that the worst may be over and the best yet to come. Post-September rally dynamics. Following these declines, Bitcoin and altcoins have historically experienced substantial gains. For example, after the September 2017 crash, Bitcoin surged by over 560% into mid-2018. Similarly, in 2021, a September correction was followed by a rally that pushed Bitcoin towards new highs. This pattern suggests that surviving September's turbulence might be crucial for positioning oneself for the big gains that often follow. It's a period where patience and strategic accumulation can pay off handsomely. Institutional interest and Ethereum's rising profile. While macro factors and seasonal patterns are critical, the real game changer is the increasing institutional interest in Ethereum and other cryptocurrencies. Over the past few weeks, there has been a notable shift in how Wall Street perceives ETH, driven by better understanding, regulatory developments, and the growing ecosystem of decentralized finance, DeFi, and Layer 2 solutions. Ethereum's institutional momentum. In recent months, Ethereum has been gaining ground as the preferred blockchain for institutional adoption. This shift is evident in the explosive inflows into ETH-based exchange-traded funds, ETFs, with daily inflows approaching $3 billion. While some analysts caution that such inflows could mark local tops, The sustained interest indicates a long-term shift in perception. Why is Ethereum gaining traction? On-chain activity. As on-chain activity increases, Ethereum's utility as a platform for DeFi, NFTs, and Layer 2 scaling solutions makes it more attractive. Regulatory clarity. Although regulatory clarity remains a work in progress, recent developments suggest that Ethereum is becoming a safe asset within the crypto ecosystem, especially given its transition to proof-of-stake and ongoing upgrades. Smart contract dominance, Ethereum's first-mover advantage, and robust developer community continue to attract institutional projects. The 1971 moment. Ethereum as the new standard. Tom Lee, a renowned market analyst, draws a compelling analogy between today's blockchain revolution and the 1971 shift when the dollar left the gold standard. Back then, the move enabled Wall Street to innovate financial markets, making transactions faster, more efficient, and more scalable. Lee suggests that Ethereum's blockchain, with its smart contracts and tokenization capabilities, is paving the way for a similar transformation. Just as the dollar's move off the gold standard revolutionized finance, Ethereum's rise is fundamentally changing how markets operate, making them faster, more transparent, and more accessible. This analogy underscores the transformative potential of Ethereum and blockchain technology, positioning ETH as a core component of future financial infrastructure. The growing institutional bid, evidence, and implications. Recent data underscores the increasing institutional interest in Ethereum. Over the past few days, ETH ETF inflows have topped nearly $3 billion daily, a clear sign of serious capital moving into the asset class. What does this mean? Long-term confidence. Persistent inflows suggest that institutional investors see Ethereum as a core part of their portfolios. Potential for multi-year growth. Unlike speculative pump-and-dump schemes, sustained institutional interest can underpin a multi-year uptrend. Market impacts. Large inflows can drive prices higher and reduce volatility, making ETH more attractive to retail investors. Caveats and risks. While inflows are encouraging, they can also mark local tops. Traders should watch for signs of overextension and profit-taking. Nonetheless, the overall trend appears bullish as Ethereum continues to attract new capital. Navigating the current market, strategies for success. Stay invested. Despite the chaos, the overall trend remains bullish with institutions funneling money into crypto. The current dip is likely a temporary correction rather than the end of the bull run. Buy the dip. If you have capital, this could be the ideal moment to accumulate leading altcoins like ETH, Chainlink, Solana, BNB, and others. These assets are likely to benefit from increased on-chain activity and institutional interest. Prepare for volatility. Use leverage cautiously. It's a powerful tool, but can wipe out your position if the market moves against you. Experienced traders can leverage their positions during confirmed moves, but beginners should proceed with caution. Watch for the September sell-off. Historically, September has been a time of significant corrections. Surviving this phase could set the stage for a final explosive rally into late fall. Longer-term outlook. Is this the beginning of a super cycle? One of the most debated topics among crypto enthusiasts is whether we're in a traditional 4-year cycle or an extended, more sustainable bull market lasting into 2027 or beyond. The case for an extended cycle. Institutional adoption. As more traditional financial institutions integrate blockchain technology, the growth trajectory becomes more gradual and sustainable. Regulatory developments, clarity, and acceptance are likely to improve over time, reducing volatility. Market maturity. The infrastructure supporting cryptocurrencies is becoming more robust, enabling longer-term growth. Implications. If this is indeed a longer cycle, then dips like the current one are merely moments to accumulate for a multi-year rise. Instead of expecting a quick 2 to 3 times, investors should think in terms of 10 times or more over the next several years. Cautionary notes. However, markets can be unpredictable. External shocks, regulatory crackdowns, or macroeconomic shocks could still trigger corrections. Diversification and risk management are essential. Survive September, and the rewards could be massive. The coming weeks will be critical. If history rhymes and macro trends align, this September dip may be the last major hurdle before a substantial rally. Bitcoin could push toward $140,000 to $160,000, while ETH could soar past $7,000 to $12,000. Altcoins like Chainlink, Solana, and BNB are also poised to benefit as liquidity flows into the broader ecosystem. In essence, this is a time to be greedy while others are fearful. If you have the confidence and capital, accumulating during this dip could set you up for significant gains in the years to come. Remember, patience and strategic positioning are your best allies in navigating this volatile yet promising market.